Welcome, everyone. Today, we are going to dive deep into a topic that is absolutely fundamental for any business that sells on credit. We're talking about the moment when the excitement of making a sale bumps up against the cold, hard reality that sometimes you just don't get paid. This isn't just about crunching numbers. It's about painting an honest picture of a company's financial reality. So let's get into the crucial choice of accounting for bad debts.
So let's start with this very real question. Picture it. You've launched your business, you've landed a big client, you've provided the service, sent the invoice, and now you're waiting. But the due date comes and goes. Days turn into weeks. What do? This happens every single day in the business world, and it can seriously impact your cash flow. Luckily, accounting gives us a structured way to handle this very problem.
Okay, so before we can figure out how to solve the problem of unpaid bills, we first need to know where this idea lives in the financial statements. This brings us to a really important asset for any company that sells on credit. It's called accounts receivable. You're going to see this on pretty much every balance sheet you ever look at, so getting a firm grasp on it now is absolutely essential for your future careers.
So, what is accounts receivable? Well, you can think of it as the company's bucket of IOUs. It's all the money that customers owe you for stuff you've already given them. Now, on the balance sheet, this is an asset, specifically a current asset, because you expect to turn all those IOUs into cold, hard cash within a year. For a lot of companies, this number can be huge, a massive chunk of their total assets. So you can see why managing it well is critical to keeping the lights on.
And here's the real challenge. You see, in a perfect world, every single dollar in that IOU bucket would be collected. But we don't live in a perfect world. In reality, some customers might face financial trouble, they might dispute a bill, or sometimes they just go out of business. This slice of the pie, the part that you're never going to see, is what we call bad debt. And from an accounting standpoint, that's not just a sad story, it's a business expense that has to be recorded. So how do we account for this inevitable bad debt? Well, there are two main ways to do it. The first one we're going to look at is called the direct write-off method. Now, this one is popular because, honestly, it's really simple. You'll see a lot of small businesses use it. But as we're about to find out, that simplicity comes with some pretty big trade-offs when it comes to financial accuracy.
The key word to understand this method is reactive. You basically wait and see. You don't do anything, you don't guess, you don't estimate. You wait until you are 100% certain that a specific customer's invoice is a lost cause. Only when you have absolute proof that the money is gone forever do you finally take it off your books.
Let's walk through a quick example. Let's say a customer, we'll call them ABC Corp, owes you $1,000. One day you get a letter saying they've filed for bankruptcy. It's official. You're not getting that money. So what do? You make a journal entry. You're going to debit or increase an expense account called bad debt expense for $1,000. And at the same time, you're going to credit or decrease your accounts receivable asset by $1,000. Boom, done. Simple, direct, and straightforward.
The big selling point here is, without a doubt, simplicity. There's no crystal ball, no complicated formulas. You just react to facts as they happen. But, and this is a huge but, this method has a major, fundamental flaw. It violates something called the matching principle, which is a cornerstone of proper accounting. And that violation can seriously distort your financial picture. So, if the simple way is flawed, what's the better way? Well, let's move on to the second, much more sophisticated approach. This is the allowance method. And for any company where bad debts are a material or significant amount, this is the method that's required by generally accepted accounting principles, or GAAP. This method isn't about reacting, it's all about anticipating.
The absolute core of the allowance method is that one powerful word, estimating. Instead of waiting for a specific customer to default, you get proactive. At the end of every accounting period, say every month or every quarter, you look at your total sales and you make an educated guess about how much of it you think will eventually go bad. You might base this on your company's past experience, the current state of the economy. It's a forecast.
Okay, let's put some numbers to this. Imagine you had $1 million in credit sales this quarter. Looking at your history, you estimate that about 2% of that, or $20,000, will probably never be collected. So right then and there, you record a $20,000 bad debt expense for the period. But look at step 3. This is critical. You don't reduce your main accounts receivable account. Instead, you put that $20,000 into a special holding pen, a sort of buffer account called the allowance for doubtful accounts.
Now this brings us to a really important piece of accounting vocabulary, the contra asset account. The name sounds complicated, but the idea is pretty simple. Contra just means opposite. So while a normal asset account has a debit balance, a contra asset account has a credit balance.
Its entire job is to be paired with an asset and reduce its value on the balance sheet. So the allowance for doubtful accounts is directly tied to accounts receivable, and its balance is subtracted from it.
And what do you get when you do that subtraction? Accounts receivable minus the allowance for doubtful accounts gives you the net realizable value. That's the real magic number. This is the amount of cash the company actually, realistically expects to collect. And if you're an investor, a banker, or a manager trying to make decisions, this number is infinitely more valuable and more honest than just the gross total.
All right, so let's put these two methods head to head. It's really important to see that this isn't just about different ways of booking a journal entry. No, this is about two totally different philosophies on how to report your company's performance and financial position, and that has a huge impact on decision-making.
The whole debate really comes down to that matching principle we mentioned earlier. It's a bedrock idea in accounting. It says you must record your expenses in the same period as the revenues that help generate them. Think about it. With the direct write-off method, you could make a sale in December of 2023, but not find out the customer went bankrupt until July of 2024. That means the revenue makes your 2023 profit look great, and the expense makes your 2024 profit look bad. It's a total mismatch. The allowance method fixes this by putting an estimated expense in the same period as the sale, giving you a much truer picture of your profitability. Okay, I need everyone's attention here, because this is the #1 thing students get wrong on exams. It's all about the timing of the expense. With the allowance method, the bad debt expense is recorded when you make the estimate at the end of the period. Later on, when you identify that specific customer, ABC Corp, who isn't paying, there's no expense then. All you do is debit the allowance account and credit accounts receivable. You're just cleaning up the balance sheet. The expense already hit the income statement earlier. Getting that timing difference down is absolutely crucial.
Now, you might be sitting there thinking, okay, professor, this is just a bunch of accounting rules. Why does it matter so much in the real world? Well, it's not just an academic exercise. This choice has profound real-world consequences for every single business and for anyone who relies on financial statements to make decisions. Think about it. Who looks at financial statements? Investors, deciding whether to buy your stock. Banks, deciding whether to give you a loan. Even suppliers, deciding whether to extend you credit. They all need to know what your assets are really worth. The direct write-off method can be really misleading because it overstates your accounts receivable, making you look healthier on paper than you actually are. And this is exactly why GAAP insists on the allowance method when bad debts are significant. It's based on a principle we call conservatism in accounting. It basically means you shouldn't overstate your assets or your income. The allowance method forces a company to be honest and realistic about its prospects now rather than waiting for bad news to become official later.
Let's do a quick role play. You're the CFO, and you're at the bank trying to get a loan. Now, the loan officer is looking at your balance sheet. In scenario A, using the direct method, she sees accounts receivable $100,000. Her first thought is, I wonder how much of that is actually collectible. She has to guess, and that creates uncertainty. Now, scenario B, using the allowance method, she sees accounts receivable, $100,000, but right under it, less allowance for doubtful accounts, $5,000, for a net of $95,000. Instantly, you've sent a powerful message. You've shown that you understand your own business, you're being realistic, and you're proactive about managing risk. That built incredible trust and makes getting that loan a whole lot easier. So, I'll leave you with this final question to think about. As the future managers, analysts, and entrepreneurs in this room, you have to ask yourselves which method provides better information. It's not just about following the rules for the sake of it. It's about having the clearest, most honest data possible to manage your cash flow, to set your credit policies, and to communicate your company's health to the world. Which method empowers you to make smarter business decisions? That right there is the real lesson today.